Hi, everybody, and good evening. It's so wonderful to see you all here in person. Oh my gosh, it's been so long. I sort of thought it would be 3 years, but somebody here, George, just told me that he hasn't seen me in 5 years. So it's been a long time. So for those of you who don't know, I'm Karen Altfest. I think I know almost everybody here. And I want to welcome you tonight to our annual event. It's a little different from other years, but certainly the quality remains the same. It's going to be a terrific evening. And who knows what business anniversary this is for Altfest? Take a guess. Think about how long you've been around. 30 years? Getting close. It's our 39th year in business. And thank you. And next year's our 40th. And who would have believed that? And so we're planning something really, really special. Actually, Emily, who you saw running around here before giving me dirty looks, she and I are beginning to look at venues for something very special for the 40th. So I know that's a while off, but we may go back to having them in June when it's a little warmer and easier to get around. So it won't be that long. So I'm so happy to see you because I was really tired of looking at my picture on Zoom. Were you tired of looking at it? I'm glad you're all in 3D. It really is important. I didn't realize how lonely I was and how I needed something more than the encounters I was having on Zoom. So this really feels good. So is anybody here planning a wedding, expecting to have a wedding? Well, you can have a wedding right here. They have weddings in the Astor House, and they have all sorts of family events and different kinds of events. And I personally think it's a lovely place. And I've never been here, and 3 different people told me that they were here in years past. So I wasn't really aware of this being a rental venue. So they do hold weddings, they do hold other events. So I'm going to tell you a tiny bit about their history. This house was built in 1927 for Vincent Astor. He was one of the sons of John Jacob Astor, who unfortunately perished on the Titanic in 1912. So I guess he didn't get to see it. But in 1939, the Vincent Astors sold this house and moved to 845th Avenue. And in 1948, the Junior League of New York bought this house, and it's now a landmark building. And so you can say you've been in a New York City landmark building. It's very hard to get landmarked, I understand. So you've been in one. It's been a landmark building since '67. And maybe you saw the Junior League plaque outside. We actually have a Junior League member here, my daughter-in-law, Avi. And Avi, wave. So she knows more about what's on those upper floors than the rest of us, because she's been at a lot of meetings there. So tonight, I'm very pleased to tell you that we have 2 really top sessions. And the first is our leadership panel, that's leaders of our firm, talking about the silver lining in turbulent times. Do you feel like you're going through turbulent times? Okay, then you want to pay close attention, because there is a silver lining. 3 of our top leaders, Andrew Altfest at the far end there, and Mike Prendergast in the middle, and Ekta Patel right here, will bring you up to date on what we especially find interesting right now at our firm. So at the end, you're going to have a card. You have some index cards in your envelope, and you're going to be able to write your questions on the cards and hold them up, and they'll be picked up by our staff, and hopefully your questions will be asked, and the panelists will address your questions. So that's at the end of the session. Then the second session is our keynote speaker with Kathy Jones from Schwab, and Lou's going to introduce that session more fully when the time comes. Again, for that session, questions can be written on index cards. Each index card is marked, so you'll know which session you're writing about. And will be taken at the end of the session again. And Kathy told me on the phone the other day, or was it on Zoom again, that she looks forward to your questions. She said it's the best part of being a speaker. So please don't disappoint us. So also please complete the surveys that are also in your folder and leave them on the gift table near the door. And Altfest staff will be there to collect them from you at the end. So to be clear, I just want to tell you that there is going to be dessert outside this room at 8 p.m. and a take-home treat at the door at 8:20. So anything else you want to know? Ladies and men's rooms are on the first floor. So now I'm really glad to introduce our president, Andrew Altfest, and directors of the firm, Mike Prendergast and Ekta Patel. Thank you.
So it's so great to be back in person with everyone and to connect with some of our favorite clients. Before I share some thoughts about something that I think is all on our minds, which is the markets, I'm going to just thank my wife, Avi, who reminded me last night that we're only here because of her. She was just kidding, I get half kidding, but she does some great volunteer work through the Junior League, helping women come out of who are coming out of prison, and is currently volunteering to help women at a juvenile home. So thank you, Avi. But I'd like to talk to you tonight about a third food category. And so just like you have fruits and vegetables, we have the same thing when it comes to investments. So there's stocks and bonds, but we've introduced a third food group into your portfolios. And I'm going to talk to you about what that is, but I think before doing that, it's going to be helpful to think about where we got to where we are today, going back in time. So if you go back to the end of last year, what was happening? Well, there was a lot of speculation in the stock and bond markets. In the stock market, you had parts of the stock market, in particular, like technology. There was rampant speculation in share prices with Bitcoin, Tesla, Robinhood was booming. We had people who were placing trades in these speculative meme stocks. Well, at that time, we were concerned about what would happen if interest rates were to increase. And we thought that the speculation could leave the stock market if interest rates moved up. The problem that you have is when interest rates go up, what happens? Well, bonds go down in price. Normally, bonds are a great hedge. They protect on the downside because when stocks go down, bond yields tend to go down and bond prices go up because people are concerned that there's going to be a slowdown in the economy. Well, if the culprit of the stock market decline is higher interest rates, then bonds are not a good hedge. They're not a good source of protection. So what we've been emphasizing in portfolios to deal with this environment are alternatives. That's the third food group that I was referring to before. And alternatives today are greater than 20% on average in client portfolios. So a meaningful allocation to alternatives. And it's not just any alternatives that we're emphasizing today, but we're asking a lot from the alternatives that we use. We want alternatives that are reasonably priced, that are good inflation hedges, that can do well in a higher inflationary environment like we're in today, and can behave differently than stocks and bonds. So that's asking a lot of what we're investing in. But what we're emphasizing are in two different categories. The first is in mutual fund format, where we're investing through funds to get an allocation to different segments of the alternative category. And then there are homegrown Altfest managed proprietary strategies that we're also utilizing today in your portfolios that are allowing us to get these inflation hedge characteristics. So what are they? Well, the first is we're investing in infrastructure investments, And so there are a number of infrastructure funds that we currently invested in your portfolios, and that gives us exposure to transportation, to digital infrastructure, so we're taking advantage of trends in the economy, as well as utilities and energy infrastructure. So some of these investments their revenues are directly linked to higher prices. So when inflation goes up, they get to raise their revenues. They're in regulated businesses, both outside the US and in the US. And so that's a very good inflation hedge for this environment. The second has to do with the transportation of energy. And so we have one investment that, while the stock market is down over 20% this year, is actually up in value, First Trust Energy. And that's because of what it invests in and the benefits of an alternative investment like energy transportation. And then finally, we also have digital infrastructure that allows us to benefit from trends in the economy, like the growth in the digital economy through 5G, through cloud computing, and different farms that are being demanded in the real estate side. So we have the ability to allocate to things that can do better and can protect on the downside, and that's what we have found from these investments. Finally, on the proprietary side, things that we manage at Altfest for you, in particular as strategies in-house, we have introduced something called the Alternative Alpha Strategy. So the Alternative Alpha Strategy, which is as much as 10% of a portfolio these days, allows us to very flexibly manage risk. So what happens in an environment like this, when you are concerned that bonds will go down and stocks will go down in tandem, and we're seeing that increased correlation, we can do things like short parts of the stock market, so bet against parts of the stock market, and those parts of the stock market, when they go down in value, our investments actually increase in value. And that's what we were doing at the end of last year within that strategy, the Alternative Alpha Strategy. Some of you might have you recognize the strategy from the more frequent trades of ETFs in your accounts. And that's the strategy that I'm referring to. We still have short positions in that strategy, and we're also hedging risk within that strategy in other ways now as well, now that the stock market has gone down over 20%. The second, and that strategy this year, let me just mention, the strategy is down 10% less than a globally diversified portfolio. So it has really helped to cushion the blow on the downside. The second proprietary strategy that we've introduced for all of our clients is the Arden Woods Real Estate Strategy. And the Arden Woods Real Estate Strategy was first launched in July of 2021. And this strategy allows us to buy distressed real estate, so real estate at very favorable prices. And we fully committed that fund, and the investments that we have in the fund represent 100% of the allocation 100% of the commitment that we have from our investors in the fund now. And the expected return of that strategy is over 20% annualized after all fees. So in an environment in which the stock market and bond market are down significantly, having a strategy that is up that is doing very well, and we project to have these types of returns going forward, is very nice to have. Now we're getting ready to launch our second Arden Woods real estate fund. We've actually already made 9 purchases in the fund, and we've bought investments that we expect to have very significant returns. I'll give you one example of an investment we recently bought a few weeks ago. We bought an investment that previously was owned by a national real estate firm that owns single-family homes across the country and rents them out. Well, this firm bought this house. It was a new construction house in 2020. They bought it for over $190,000. And we were able to buy it at auction a few weeks ago for $140,000. Now, what's happened in the last 2 years? The real estate market has moved up significantly. We bought it for $140 in 2022. They bought it for $190, so we bought it at a price significantly lower than what they had bought it for. The return, the gross return of that investment is projected to be over 60% annualized to our clients, to our investors. So this is not, I'm not picking the best investment. There are a number of investments like that within the fund. So we're going to be talking to everyone in this room who's an accredited investor, which is most of our clients, about this fund in the coming weeks. So there'll be more to share. We'll be happy to go through this in more detail. But we continue to emphasize this as an alternative as well as the other alternatives in portfolios today. So on that note, I'm going to turn it over to my colleague Mike, who also has some timely information to share with you on another topic.
Great. Thank you very much, Andrew. And hello, everyone, and thank you very much for coming to the annual event, Altfest annual event tonight. It's really great to see everybody in person. And my talk tonight is going to be about estate planning opportunities in turbulent times. So let's get right to it. Now, what are some opportunities related to estate planning that look interesting in today's environment? Well, how about paying less taxes, less in estate taxes when the time comes? Now, this wouldn't make Uncle Sam very happy, but getting more money into the pockets of your heirs is probably going to make you very happy. So how can we reduce our estate taxes? First, let's have a little bit of background. So as you know, when you die, all assets that were under your control are seen as part of your taxable estate, to be taxed at the federal and maybe the state level. The amount of your taxable estate is then reduced by the amount of federal gift and estate tax exemption that you've not yet used, and that remaining part is then subject to federal estate taxes, which start at about 18% and then quickly go to about 40%. Your state might have an estate tax as well. New York and Connecticut do. New Jersey does not, but it does have an inheritance tax. And some people also gift assets to their loved ones while they're still alive. And these assets, upon gifting below a certain amount, are no longer part of the gifter's taxable estate, and so are no longer subject to any estate taxes upon the gifter's death. And of course, also any future growth in the value of these gifted assets is also outside of the gifter's taxable estate. Right now, though, two things are happening which make considering gifting assets out of your estate even more important. The first thing is that the combined federal estate and gift tax exemption is the highest it's ever been. Right now, about $12 million for a single person and about $24 million for a married couple. It's also very important to know that this federal estate and gift tax exemption is scheduled to be cut in half at the beginning of 2026 to about $6 million for a single person and $12 million for a married couple. This gives everyone the opportunity for a limited time to gift more assets out of their estate, if it makes sense for them, federal estate tax free. This is a use it or lose it opportunity. So for example, if you gift $1 million out of your estate, your taxable estate, you may be able to save about $390,000 in federal estate taxes. The second thing is that this year, the values, as you might be aware, of some assets, some investments are temporarily down. Now, in the estate planning world, this can be a good thing. This means that if you gift some of these assets out of your estate now, not only will you be able to take advantage of the highest federal estate and gift tax exemption, but you'll be able to use less of that exemption because the assets are down. Not only that, but you will be able to take these assets that have been temporarily compressed down, kind of like a coiled spring, and once the economic conditions and market volatility improve, it's highly likely that these assets will spring back to their true value, and all this springing back will be outside of your taxable estate, federal tax-free, as well as, again, any future growth in these assets. So for those clients who have more assets than they'll be able to use during their lifetimes or need during their lifetimes, now is a golden opportunity to transfer some of those assets to their loved ones, free of federal estate taxes, much more than they might be able to in a couple of years. State estate taxes, of course, could be a different story. Wait a minute, though. I can already sense, with my Spider-Man sense, that some people in the audience are having some concerned thoughts. And they're saying, Mike, I love you, but, gifting assets out of your estate that you don't need is all well and good for some people, but what about me? I might need all of my assets, to fund my lifetime expenses. So it looks like everything that you've just said just doesn't apply to me. Is that right? And I'd say, well, yeah, that's true. That is correct. But the good news is there's another estate planning opportunity that could help you, as well as those who are thinking just like you. Enter the SLAT, the Spousal Lifetime Access Trust. What is it? Well, a SLAT is an irrevocable trust that one sets up during one's lifetime for the primary benefit of your spouse. Assets that are gifted into the SLAT are removed from the gifter's taxable estate. The gifter loses direct control of these assets, since they've been transferred into an irrevocable trust, but retains indirect access to these assets, because these assets are supposed to be used potentially for maintaining the lifestyle of the gifter's spouse, if needed. As long as the gifter and the spouse remain married, distributions to the SLAT to provide for the gifter's spouse will also indirectly provide for the gifter. So here you actually might be able to have your cake and eat it too. You'd be able to get assets out of your estate for federal and potentially state estate tax purposes, but retain indirect access to them in case you need to use them during your lifetime. You could create a SLAT for your spouse's benefit. Your spouse could create one for your benefit so that you're both covered. Another potential benefit of creating a SLAT or SLATs is that they might help to save a lot of New York State estate taxes if you're a New York State resident. New York State is notorious for their cliff estate tax. This means that if your taxable estate is greater than 105% of the New York State estate tax exemption, currently about 6.4 million, New York State will start charging estate taxes on your whole estate starting from $1. Not very popular. A SLAT could potentially reduce your taxable estate to below the 105% threshold, enabling you to severely reduce your New York State estate tax burden, if not completely eliminate it. SLATs are beginning to sound pretty good right about now, aren't they? Well, they could be, but there are a couple of important things to be aware of regarding SLATs. First, for SLATs to work, this marriage needs to be solid. If the marriage is not strong, here's some whispers in the audience. If the marriage is not strong, a divorce could mean that the assets that you had transferred for your spouse's benefit, which you could indirectly access, might turn into assets that you transfer for your ex-spouse's benefit, which you cannot access. Not a great potential outcome. Second, if the spouse dies, the SLAT created for the benefit of the spouse either remains in existence for the benefit of the secondary beneficiaries, usually the children, or the SLAT is dissolved and the benefits all go straight to the children. Again, the spouse who gifted the SLAT for the benefit of his or her spouse would not be able to have access to those assets. Third, if you create reciprocal SLATs, one for your spouse, the other one for you, you need to make sure that they are different enough so they do not run afoul of the IRS's reciprocal trust doctrine. This doctrine states that if the two SLATs are similar enough to each other, they will be seen as purely a vehicle to avoid estate taxes. Of course, we wouldn't do that. Disallowed by the IRS, and the assets will then immediately revert back to everyone's taxable estate, spouse and gifter. Now, there are ways to make the two SLATs different enough so that they are upheld by the IRS. An experienced estate attorney will be able to help you with this. But that brings up another aspect that we need to talk about, which that slats have cost. The cost to set up a slat starts out at least a couple $1,000s and can be much more. And if you have independent trustees to oversee each slat, they of course will have annual expenses as well. Now for those of you who are not interested in these strategies or for whom they do not apply, there are still evergreen estate planning strategies that do apply. So regardless of market or economic conditions. Now, for example, for those of you who plan to generously give some of your estate to charity, naming charities as beneficiaries or partial beneficiaries of your tax-deferred retirement accounts like IRAs makes a lot of sense. It can also make sense to get your durable power of attorney on file with all your financial institutions so that things go smoothly if the document ever needs to be used. Again, this is the document that gives the person you choose the power to conduct financial transactions on your behalf if needed. Now, if it's been also more than 5 years and if it's been more than 5 years since you've had your estate documents done or updated, now is the time to have them updated, as the estate laws have changed dramatically over the last couple of years, and this could result in old documents creating negative implications or negative problems for your heirs down the road. And of course, don't forget that you can right now be able to give $16,000 per person per year to as many people as you like, and it will not count against your federal and estate gift tax exemption. As you can see, regardless of what's happening in the markets and the economy, there are always opportunities to benefit you financially and to make your financial situation stronger. We touched on just a few estate planning items tonight, but all throughout the year, your Altfest personal wealth management team is constantly working to identify opportunities in all areas of personal finance that can benefit you, and then partnering, if needed, with other professionals on your wealth management team to realize these opportunities for you. And now, without further ado, I'm going to turn it over to Ekta Patel, who's going to speak about some strategies that will help us keep our perspective in these volatile times.
Thank you, Mike. Hi, everyone. Hi, it's nice to see you all in person. At least it's been a few years, and so happy to see you all. So I was just talking to some of you, and usual hi, hellos, how are you? And I get back, I'm fine. And the next thing is like, I can't get my courage together to see my account. I don't know how much further down they are, or I was fine until I looked at my accounts. So, but you are not alone in this. Trust me, we get a number of calls on regular basis, clients being concerned, and rightfully so. We are in a turbulent economic situation, so people are concerned, especially if you're retired. You want to know what's going on and if you're going to be okay. And this may sound a little bit like cliche, but generally our job is to, talk you off the ledge, right? Everybody's psychological threshold to panic is different. Mine is also, and it's tested in these environments as well. But the idea here is staying invested, right? It's very difficult to get out of the market and then trying to time to get back into the market. Relatively speaking, let's say if you're trying to get out of the market, then there's also getting back into the market, right? So if you think you are right in getting out, but then when do you get back? Essentially, you have to be correct twice, once when you get out and once when you get back in. And it's a very difficult thing to achieve, to be right on both ends. So generally speaking, that's why we tell our clients to stay invested. And also some of the worst performing days that you see in the market, they come in sort of groups, and they come very quickly. So you might be able to avoid it, but then in order to get back in, again, you have to be right to be able to take advantage of some of the best performing days. So that's the reason why we tell our clients to be invested and stay invested. And I think one way to think of volatility in general that we are concerned about these days in the market is it's the cost you pay for achieving higher returns over a longer period of time. It's an offset for achieving higher returns and keeping up with inflation over a longer period of time, and to meet whatever goals you may have. The other thing it will help you keep things in perspective is look at the portfolio in terms of relative performance, right? We manage highly diversified portfolios for you. So comparing it to just a Dow or a NASDAQ probably is not appropriate. So looking at portfolios at appropriate benchmarks would make a lot of sense going forward. Now, unfortunately, running a diversified portfolio doesn't mean that it won't decline or it won't participate in the markets, because especially in a year like this, when equities are down, bonds are down as well. There's no place to hide in bonds as well. But having a diversified portfolio will certainly help you decline less than the market. And that's been the case, as Andrew earlier mentioned, that having alternatives has helped us quite significantly. Now, staying invested doesn't mean we are not making changes, as Andrew suggested earlier. We are making a number of changes in the portfolio, and the number of transaction confirmation you're receiving on your end are evident. Sometimes it's daily. So we've been taking advantage of dislocations in the market, looking at opportunities, but doing all of that while keeping an eye on the risk management side of it. So for instance, late in 2021, we took a more of a cautious approach. We felt that there is a lot of risk in the market, so we turned a little bit defensive. And in hindsight, we were a little early to do so. But earlier this year, when markets started declining, that cautious approach really helped us in mitigating risk. And you could see that your portfolios are down less than the market in general. Now let's talk a little bit about the strategies. Yes, we want to stay invested. Yes, we have diversified portfolio, and yes, we are mitigating risk. But what else we are doing? One of the things that we're doing is we're taking advantage of tax loss harvesting. Now, what is tax loss harvesting? Is basically, taking the losses that are in the portfolio and using it to our advantage, not just for this year, but for future years to offset your gains. Now, this strategy is not new. It's just that it's a year in which it can be more beneficial to you. So in a year when the markets are going down, we are presented with many occasions on which we can harvest losses and use them to offset the gains that we have, not just this year, but maybe in 2023 and 2024. So let's use an example. For instance, a portfolio was worth $1 million at the beginning of the year, but now it's declined 20%, it's worth $800. And so the inbuilt loss, the paper loss in the portfolio, is about $200,000. So the idea is to sell your account, and very simplistically speaking, of course, and take the 200,000 losses. So now you just convert the paper losses into real losses that you could use, all while staying invested. We'll use the 800,000 and go back in the market. Again, let's not time the market here. Let's stay invested. So you can use that 200,000 now for future gains. And you're allowed to carry forward the gains for a number of years. So that helps you manage your tax bill over time. Also, you can offset the losses for about $3,000 annually against your ordinary income. It's not much, but it's something to think about. The key point here is that you can only do that, efficiently or effectively, I should say, when the markets are down. So now is the time to really react on that. And I know it's nerve-wracking where the markets are, but we could use this strategy. We have already started doing that for our clients. Another such strategy is my favorite topic, and everybody at Altfest will vouch for it, is Roth conversion. Some of them even turned my middle name to Roth, so it was a joke going on at Altfest. But Roth conversion is appropriate. Again, it's only appropriate for those where we've determined for you and talked to your accountants that this strategy could work in your favor. So it's not for everybody, but a market like this presents opportunity for those at least who is appropriate to go ahead and convert to Roth. And this can be done throughout the year. It's not sort of like one-time deal. So what is Roth conversion? Very simplistic speaking, you take money from your pre-tax IRA, take some money and move it to post-tax IRA, which is the Roth account. And the amount you move is your now taxable income. So you're required to pay taxes on it. So there's a catch for taxes. But setting that aside, when the markets are down, the values of your accounts are down, right? So essentially what you're doing is taking your account at lower valuation and transferring the pre-tax money into post-tax account. And then when the market bounces back, that allows the Roth account to put all the growth in the Roth account, and that growth becomes tax-free. So if you leave it in your pre-tax accounts, then it's a taxable. You'll still see the growth, but it'll be taxable. But if you move it to Roth, then it becomes tax-free in general. So these are some of the things we are thinking about. Some of the other benefits of Roth are you're not required to take distributions from Roth accounts. So in a traditional pre-tax IRA, when you turn 72, you're required to take minimum distributions, which is your taxable income, and you'll pay taxes. Whereas in Roth, you're not required to do so. So you're basically, paying tax now, and as long as you leave it in Roth for several years, your growth in Roth will offset, hopefully, the taxes that you paid today. But you're not required to take distributions. It is also helpful for legacy planning. Many of you want to pass on these assets to your children or other heirs. So Roth could be a good place where you can transfer post-tax money to your kids or other heirs where they don't have to pay taxes when they inherit it. So these are some of the strategies that we are working with. Again, these strategies probably make more sense in a year like this than other years. So it's not something that we only think about it this year, but just something to make you aware what are the other things that Mike said we are thinking about. The idea really here is to sort of, yes, we want to do everything we can to mitigate risk, but to keep the eye more, on your long-term planning, and not just be very short-sighted in that way. When we do planning for you, financial planning for you, we do take market fluctuations, inflation fluctuations into account. So we try to get more realistic of a view of your financial plan, and we want to see what the impact of those fluctuations would be on your future assets and whether you can meet your goals or not. So at the end of the day, we have already thought about these things. And there are many factors that impact the market, right? Volatility is probably, in my opinion, an integral behavior and probably, good for the markets, healthy for the markets in some ways. And there are a number of factors that I think that affects some of them that we can't control, right? We can't control economic policies. We can't control fluctuations. We can't control market performance. But there are factors that we can control. We can control our risk tolerance. We can control our asset allocation. We can diversify the portfolios. And we can use tactical strategies that we all mentioned today. So it's important that we focus on the factors that we can control and have an eye on our long-term planning to just keep perspective in these difficult times. So I hope that's helpful. And if you are really concerned, please pick up the phone and give us a call, and we're happy to speak to you. With that, I'll turn it over. And do you have any questions? I think I'll turn it over to John.
Yeah, so we're going to go into our Q&A portion. So if you have any questions, Dennis here to my right will just come by and grab some questions. But I'm going to get it started with at least one. And I'm going to come back to Ekta here for a minute. And the first question is, when markets are down, like in 2022, okay, how do you manage withdrawals for clients? Wouldn't you have to sell at lower prices to take a permanent loss?
Good question. Yeah, it's like I said, it's quite difficult if you've just retired or if you're relying on withdrawals from them and you have to sell it at a lower point. Often what we do, if we know that withdrawal is coming, we try to plan for it for you. We try to keep higher cash cushions or keep investments or more amounts in short-term bonds and things like that. But if you have an immediate need that we had not planned for, then we could look at the portfolio and try to raise cash from the areas that have stayed relatively stable or have gone down less, which allows, in my opinion, the assets that have gone down significantly to bounce back. And at some point, then we will rebalance back and plan for future. But yeah, I mean, withdrawal, there are a number of ways you can plan for it, but at a high level, this is how we do it.
Good. Thanks, Ekta. Next question, I'm going to come to Mike for a minute. Mike, can you talk a little bit about the difference between the springing power of attorney versus the durable power of attorney?
Yes, this is a question that we frequently get. And so basically, a durable power of attorney is a power of attorney that you create, and then once you file all the legal paperwork and you sign it and everything, it basically is in existence. It is valid. It is a live document. And again, this is the document that if you, the person who creates the document, were to become temporarily incapacitated, maybe, God forbid, you are hit by a bus, but now you're in the hospital and you're recuperating, but you really can't make financial decisions, and you need money to pay, medical expenses and physical therapy and everything. If you can't do it, this document gives the legal right to someone else whom you've designated as your agent to take care of that for you. Call the financial institutions and say, please wire money to this institution or that institution. We need to pay some bills. So durable, once it's set, it's going on forever. It's a live document. Now, a springing power of attorney, as the name says, it basically will spring to life. So it's a document you create, sign all the things, it's all ready to go, but it's not live until it's sprung. Now you say, well, what causes it to be sprung? Well, that's the very important thing, is that in the document, you have to precisely determine the terms under when the document will become live. And it's, usually, when the person's incapacitated. But how do you define incapacitation? How do you define if the person is, isn't as sharp mentally as they used to be able to handle complex financial decisions? You need to spell it out very carefully in the document. Otherwise, what can happen, which is why we recommend using a durable power of attorney, although there are pros and cons, is that if it's not spelled out clearly, then the agent might think, the person, I think, really can't really handle financial document decisions right now. I should spring into action. And then the person who gave the document says, wait a minute, I'm fine, I'm good. I don't want you to do anything. And then you would go to usually at least one doctor to make a determination one way or the other. It can become a long, involved mess. It can cause fighting amongst the family, and you don't want that. So springing will happen once the triggering event happens, but you have to really define it well. Durable starts from the beginning, but it is a live document, so you want to make sure that in both situations you assign as the agent someone that you really trust, and you also want to make sure it's a personal decision whether you make the durable power of attorney document live at financial institutions and let the person know that it's existing, or maybe give instructions to your attorney that if anything happens to me, to let that person know, so that there's not a temptation to maybe go start taking money to go for a trip to Las Vegas while it's live documents, while you're basically, in the Hamptons, having some fun.
Thanks,
Long-winded
Mike.
answer, but I hope that.
We're gonna stay with you for one more estate planning question.
Wait a minute.
But the question is, are there any good vehicles for single people similar to SLATs?
Good question. At the moment, I'd say on a broad sense, not really. So you could say getting discriminated against, right? Like, why are you marriedist? Why are single people getting the raw end of the deal? Maybe I would say this: if there's something that is very interesting to you, I would say definitely it's something to speak with your wealth management team about, your primary advisor, probably bringing in the strategic advisor. And based on your situation, we might be able to see, are there any kind of potential piecemeal solutions that might be able to give some of the benefit. But the bottom line is, as it stands right now, the married people, this is one in their win column. And I guess the single person's lobby in Congress is not as strong enough yet to get it through the goal line.
Ekta, we're going to come back to you for a minute here with a question regarding market and inflation fluctuations. So the question is, how do you take into account market and inflation fluctuations into your overall planning?
So we run a number of types of analysis when we do financial planning work for our clients. One of them is pretty linear, it's pretty straightforward, that we project you to live until age 99, and each year, the inflation will go up by the same number, the returns will be the same, et cetera, et cetera. So that's one way. The second way we do it, which is what we like very much, is probability analysis. So where we'll run about 1,000 times the same analysis. We call it 1,000 different trials, or even you can run it even more. but it's a good sampling. And in each trial, the market returns will be different. Inflation would be different. So sometimes you have above average market returns, above average inflation. Sometimes markets are down 20%, inflation is high, and vice versa. So we run that 1,000 times. And what we are looking for there is that we want a certain level of number of those trials to be successful. And what that means is that there has to be a certain number of trials where your assets are outliving you. And for us, that threshold is pretty high. We want 90% success rate. So we're looking for 900 of those trials to be, where your assets outlive you. So that's how we take, market fluctuations and inflation fluctuations into account.
Good. Thanks, Ekta. At this point, we're going to move into the next portion of our agenda here. So without further ado, Lou and Kathy.